You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time, once again, for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. 15 programs for you guys to choose from, including many, many great archived episodes of this fine program, Volatility Views. And where can you find that all? Well, a bunch of places. Probably the easiest place to get it all is, of course, the mothership, the flagship, theoptionsinsider.com. Choose your program there from the call out there on the right-hand side of the homepage, and your audio journey has begun. You can always just mainline all of it as well to subscribe to our network in your platform of choice, iTunes, TuneIn, and Stitcher. You can subscribe to individual shows. You get the network, you get all of it. So make sure you're ready for that. That's a lot of content, but I think you'll like it. The daily news show, all of our futures options programming, our advisor programming, option block, all that fun stuff, all there in that feed. And of course, you can always grab us via our mobile app as well, available for iOS, Android, and the beloved Fire OS. And of course, those of you who are available can always join us every Friday, noon Central, 1 p.m. Eastern, via Mixlr, MIXLR. So if you just got to have the show live, then we got you covered. If you also want to get it before it goes live to our network the following morning, we always post the live broadcast recordings there on Mixlr as well, so you can grab those after the fact if you don't feel like waiting. And if you want to wait for the perfect polished product, of course, it goes out to the full network that following morning. And however you listen, live, after the fact, via the app, however you get it, we love to hear from you guys. So send in your questions, send in your comments. We love to hear your questions. You always ask such weird and wild and wonderful questions, and we love to hear from you guys. And joining me on the old program today, let's start off with my usual cohorts, my partners in crime, starting off with Mr. Mark Sebastian, the Greasy Meatball himself, from Carmen Line Capital by way of Option Pit. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
Good to be here. What a day, huh?
Where are you beaming in from today, sir?
I'm out in Riverside. I was helping, got my in-laws in here. It was my son's 7th birthday yesterday, and we are working on his Pinewood Derby car. So
they still do that, huh? The old Pinewood Derbies?
Oh my gosh, you have no idea. It's gone from like, oh, we're all going to build it to all with all these YouTube people. Like, there's like, well, you need to, rig the car to do this and that and this and that. So there are some like dads that just go, absolutely nuts over this thing.
I believe it. I used to crush the Pinewood Derby. I have many Pinewood Derby trophies in my old home.
Yeah.
I will admit though that my dad was a big fan of that as well. So we had some good team building.
They made a lot of the old tricks illegal, like foreign stuff. But there were guys that like try and sneak in like illegal wheels. Like that's how crazy people are.
That's
so
awesome.
It is. I mean, it's awesome in a like. Well, it's like my first full-on experience of like, like super over-involved daddom. As the 7-year-old, he's in like quasi-competitive sports, but not like straight up full-on competitive sports. And just hearing some of the stories is stupefying.
Well, get ready for a whole lifetime of overwhelming daddom coming your way very shortly. Unfortunately, Dr. VIX can't join us this week. He is on assignment, of course, Mr. Rhodes from the CBOE. He is off getting that aforementioned, getting all the paperwork in order, so someday he hopes he can become a Dr. VIX, but we have a great stand-in for you. Old friend of the program, Mike Thompson, a portfolio manager over there at Typhon Capital. Mike, welcome back to Volatility Views, and Happy New Year to you, sir.
Happy New Year to you guys, too. Thanks for having me back.
Yeah, his boy's younger than mine, so he may not quite be ready for Pinewood Derby. I mean, he's got girls, but I don't know. I saw his wife posting Girl Scout cookies for sale. Buy them here, not from any of those other crazy women.
We signed you up for about 30 boxes.
So, he's got his tastes.
All right, so crazy daddom comes in all shapes and sizes, and so is volatility. So let's get started with our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that music means it's time for the Volatility Review, the portion of the program, as the man said, where we break down the week that was and indeed still is from a volatility, trading, and analysis, and trending, and developments, and activity, and research perspective, and all of the above. Like I said, we are streaming it live here on Friday, January 13th, right around middle of the day, noon central here. So we've still got a few hours left in the session, and a little bit of a quieter one to end the old week. Everyone probably keeping some of their powder dry ahead of next week, where a lot of things are going to start hitting the fan. Most of the major indices kind of mixed on the day. The Dow kind of unched S&P, and S&P a little bit to the upside. Tech-heavy NASDAQ, Hughes, up about nearly half a percentage point, so leading what charge there is today coming in the NASDAQ realm, and VIX Cash exhaling a bit off about a third of a handle or so, right around that 11 and a quarter level to kick off the program. Speaking of kicking off, like I said, it has been an interesting start to 2017 so far from a volatility perspective, a wee bit quieter than about a year ago when things were, I think, to put it mildly, rocking and rolling. So, Mike, you are our guest. I will give you pride of place here on our volatility review here. Kick us off. How is your 2017 shaping up, and what activity really caught your eye this week from a volatility? Obviously, you guys at Typhon, if our listeners don't remember, obviously you play mostly in the VIX Futures space. So how are things shaping up over there on the VIX Futures front?
Mm-hmm. Yeah, so like you mentioned, pretty gangbuster start to the year for equities on the up, and obviously volatility going to sleep here. I think part of that was set up by the last couple days of 2016 weren't that great for stocks, so VIX was a little bit into the end of the year, and then you kind of have positive seasonality of the new year money flows that come into retirement plans and then get invested in the market. So all that sort of set up for a nice trade for us. The curve was pretty steep in contango, so we were able to take advantage of that. We think things are a little too quiet, but there hasn't been much disturbance in the force, if you will, to get volatility too excited, even outside of the mini little sell-off yesterday that happened for about 2 hours maybe after Trump's press conference. So it's been a good start to the year for us. And, we're coming to the end of the January cycle. So our mullet trade will be cut in half, if you will. So we're short the front and long the back.
I was just going to ask you which of your many interestingly named, shall we say, strategies are setting up. It sounds like it is a Mullets time. Why don't you walk our listeners? It has been a little while since you guys have been on the show. Why don't you walk our listeners through that mullet strategy, what it involves, as well as I think what else you have? You have the kick the can. You have a few other very cleverly named strategies going on over there in Typhon land.
Yeah, so the mullet, obviously our favorite code name for a position or a trade, but generally speaking, when VIX futures are steep enough in contango, we like to try to collect that roll down or that carry in there. So we'll be short in some combination the front months, so hence the short in the front, and we'll be long in the back at different ratios. So we're trying to pick up that carry or that decay in as risk-managed fashion as possible. So that's the setup or the position we've been in since the beginning of the year. And, that could, given these current levels, that could transition into Tellum, which is a reverse mullet where we're long the front and short in the back, depending on what our signals are telling us. So we could transition into that next week.
Oh, I forgot about the Tellum. And so you have the mullet and the Tellum. Am I crazy too? Wasn't there a kick this can strategy, or is that just when you want to sit on your hands and you don't want to do anything for a few months?
Far more popular in the era of central bank intervention and accommodation. And then for things like, when we first started talking, kind of the hot button for volatility was, European debt problems and that crisis, and continually, central banks and governments have elected to kick the can down the road, short-term patches. So all those intermittent volatility rises were essentially shortable events because of the sort of way out of the immediate problem was literally to kick the can down the road.
Oh, I see. So it was more of an interventionist named than any sort of real trade on your part. And I'd be remiss, I'm sure some of our listeners want me to ask. It seems like every time you come on, you have some sort of new well-named strategy in the offing, in the works. What is your, if you have one, what is your newest addition to the ever-popular suite of strategies, and what, of course, is the name that went along with it?
Yeah. Well, we haven't come up with any new ones lately. We're in the lab. We're continually working on something that we want to name after the spicy meatball himself. So when I come up with that, it's got to be fantastic and explosive. So we'll let you know when we come up with that. Fantastic
and explosive, just like me.
Exactly.
Unfortunately, if it was a spicy meatball, you'd be correct. He is indeed the greasy meatball. So your strategy needs to involve some sort of I think slippery component to it, and then I think you would have all of the elements assembled. Speaking of assembling the elements, Mark, what has been on your radar? What's been catching your eye from a volatility perspective this week over there at Carmen Line, as well as in the land of the pit?
I mean, it's just the flatness of volatility. And the way, what was striking was, at one point we're down over, about 1%, and vol has done zilch. Sell-offs seem to be mostly not believed, and people seem to feel very comfortable with a 11 handle VIX, and maybe we might even see a 10. I mean, this week we saw, I believe, VIX settled 1196. That was a nice low for the weekly. We might see lower for January. I know we're going to a long weekend, but we are setting up for a print in the low 11s. It's entirely plausible. We're up on Tuesday. UVXY had a big reverse split. Now, this is something I actually was going to ask Mike about. I don't know how much you guys have looked at this, but anecdotally, there is a correlation, in my opinion, anecdotally, so this is not a proven theory, that when one of these big ETFs or ETNs announces that they're reverse splitting, that VIX futures get completely slapped, and that typically signifies a low volatility period. I know that, the last time we talked, it was not something you'd looked at specifically, but I saw the other twin, his eyebrow pop up. I was wondering if you guys got a chance to look at it, but and whether you kind of feel the same way, and Mark as well.
Yeah, I think on the reverse split stuff specifically, it's no different than why like a normal company would split their stock to appeal to a broader range of investors, right? So when you get a reverse split, I think you do see some of like some of the bargain hunters, if you will, that would be willing to buy a $6 stock and to ultimately see Vega flow into those ETFs and ETNs. Maybe that marginal buyer is not going to be as interested after one of these products reverse splits. So for a certain period of time, you probably have, that kind of that retail flow that would ultimately push up Vega outstanding in those ETFs. You probably don't have that in the near term. So yeah, I think there probably is something to your anecdotal observation of the mechanism of a split actually affecting VIX futures.
It's funny. I'm always a wee bit skeptical, shall we say, whenever we see these reverse splits in the volatility products. That's long established. We've talked about this before in the past. By the way, listeners, if you're not familiar with UVXY, it is, of course, the VIX short-term futures, ProShares ultra short futures ETF out there, right around a little bit over about 30 right now, 30.17 out there right now. And yeah, whenever we see these products, we talked about this before with some of our other many products that essentially have to survive via reverse splitting. Otherwise, they would have gone the way of the dodo a long time ago. So I'm always a wee bit skeptical, shall we say, whenever these things happen. But I think they do. There's that kind of, we see this even in broad, equities as well. Whenever you see these reverse splits, there's certainly a retail inrush into these products. People for whatever reason, seem to think they're more viable or interesting, perhaps as a result. And also we see maybe there is. I haven't looked at the commensurate impact on the VIX futures, but I have to imagine, given that sort of always we see that playbook play out in a lot of broad products, so it might indeed play out in the futures as well. Speaking of the futures, we've been talking a lot here over the last few weeks about VIX futures. Of course, they're doing that inevitable dance between the cash and the front month future. That premium was around 1.5 or so in recent weeks. It's down to about a point now between the cash and the Jan future. The premium between the cash and Feb a little bit steeper, about 270, 2.7 or so out there between the cash and the front month, and the 2 months out there. Speaking of the futures as well, Mike, we didn't get to have you on for our first show of the year, so we didn't get to have your thoughts on 2016 and what an interesting year, shall we say, it was from a volatility perspective. Along those same notes, one of our other friends of the show, Bill Luby, posted an interesting article recently, and he kind of summarized the year in VIX futures in pretty much 2 words. He called it extraordinarily average. Let me see if I can get his exact words here. And there's a cool visual in here as well. We'll include that link to that article in the show notes, listeners, so you can follow along. His exact words were, the 2016 VIX futures term structure was closer to its historical average in 2016 than any prior year since the launch of VIX futures, all the way back in the dark ages of 2004. So kind of an interesting way, I think, to summarize 2016. It wasn't the most perhaps compelling of years with a few stark outliers there in terms of Brexit and election, and a few others that really drove some interesting volatility moments. But outside of that, I think, as our buddy Bill would say, it was, what do you call it? Extraordinarily average. Would you agree with that assessment there, Mike? Because obviously you guys spend all your days knee deep in the VIX futures. And then B, maybe if you have any other thoughts to close out the year here on 2016, what kind of stands out to you aside from the extraordinarily average moments? Maybe some thoughts on those crazy moments of Brexit or the election where everything was crazy right up until it wasn't, and a lot of other fun stuff. So your thoughts on last year from a vol perspective, Mike?
Sure. Yeah, I like Bill's description as extraordinarily average. I think, to me, looking back at the year, the most stunning thing is that the averages did end up the average. I guess that's a function of math and the number of days observations there. Is average by anything but a normal, path to average. So you had all those big outlier events. I think people since it was so long ago, people forget it was, the worst start to a S&P year, I think, ever, right? But it's a low point in mid-Feb of last year. The night of the Brexit, the VIX Futures, Sebastian and I were talking that night. I mean, they're getting dangerously close to where if they had opened at that level, or maybe, a little bit higher, that some of the inverse vol products could have been, dancing with quite a bit of danger for that lower level knockout. So it was a year of average, but by no means a normal path.
I mean, can you imagine a year where the VIX shows a normal average and we saw overnight 2 limit downs?
Right.
Think about that. That is astounding. Now that I think about that, we had 2 separate events that caused an overnight limit down, and yet vol was so low the rest of the time that we had a mean of what amounted to the mean of the VIX.
Yeah, that is pretty impressive. You think about how low those troughs had to be in order to balance out those a few aberrant moments, and they were few and far between. I mean, if you remember last year, we had extended periods of time into the late summer, even in early summer, outside of the Brexit moments and other periods where it was just a kind of a volatility desert out there. Wasn't a heck of a lot going on. Of course, a lot of that being reflected in the overall numbers for last year from an overall options volume perspective, down about 2%. Of course, if you're saying, hey, where's my vol coming from in 2017? Well, some people are calling for, actually quite a few people are calling for a more volatile year compared to last year. We'll get to your thoughts on that in a little bit, listeners, in the volatility voicemail. You guys have some interesting thoughts on that as well. But this seems like it's this time of year. We see a lot of these articles popping up all over the place. Bloomberg, Barron's, et cetera, et cetera. This one happens to be from Barron's, but there's a bunch of these out there. Pretty much talking to portfolio managers. I think this one talks to a manager from Credit Suisse who says they feel that this year is shaping up for a more volatile year. She's calling for a median level, not mean, listeners, a median level of 17 for the VIX for 2017, that with a low of 11 and a high of 40. If you remember our end show from 2016, listeners, we did our own guesstimates along those levels. She said it's going to be higher than last year's median, which was 15.8 with a range of 11 and a high of 28, which is kind of interesting to think about. That it seems low given those peak points we were talking about, but we all know how low the year was. So I guess in retrospect, it makes a lot of sense. I don't know. So what are your thoughts about that? I know, Mike, you guys are currently, I believe, in the Mullets, not the Tellum. Are you buying what Credit Suisse is selling here, and you think we're heading for a higher overall, maybe mean and median year for VIX? Or you think it's going to be another quiet period here for the rest of the year?
Yeah, I think, in general, I agree with their premise. I think it's always easy to say, like, volatility is going to rise looking forward, especially coming out of a period of, recently low VIX readings. I think you get real high VIX and kind of sustained over 20 VIX in periods where there's, more of a kind of a liquidity or redemption spiral. And we haven't seen that in, basically since a little bit in 2011 when the European debt crisis was going on. And since then, you had just more and more push into index level products, whether they're ETFs or index tracking, funds and that kind of thing. So I think that secularly has a depressing effect on index level vol. So I think into 2017, it's clear the Feds are moving, some accommodation. So the pieces that were in place up until now are changing. And I think, it's been historical precedent. Every new president kind of goes through some initial challenges in implementing whatever they're promised or talked about on the campaign trail. So I could see easily the VIX averaging higher than last year, just as a function of math. You come in pretty low into the year, and the environment is not as the intervention environment or the central bank support is not as 100% there.
Yeah, it's interesting. While I was thinking about it, while you said, the high of the VIX was only 28, the cash, is that just during trading hours? Because I can't imagine a scenario where, because I think the VIX Futures traded 26 that night or 27.
Yeah, the futures got up there.
Brexit.
I don't think the cash ever in the open hours ever.
We
hit
ever
that level.
open hours. Yeah. So, looking at things in perspective, I think maybe one of the things we need to recognize is that there is now a lot of noise that really affects things overnight that we're not seeing in the static VIX data anymore. So I would say that last year, if you think about it, if overnight we went limit down and VIX futures were up almost 50%, I think at one point they were up 70%. We, on the night of Brexit overnight, had a cash VIX of well over 40. I don't know. I mean, just kind of doing the math of how the two move. Mike, what do you think?
Yeah, I think you and I were talking that night. I would agree if the spot was open during that window of time when S&Ps went limit down and VIX futures, they were trading like 28ish or something.
Yeah, 27. Yeah,
easily mid 30s on spot. So yeah, the overnight is as important. An observation window as the day session.
So the interesting thing is you can't really look at spot VIX the same way we used to, especially now that VIX futures trade pretty actively overnight, and S&P futures absolutely trade actively overnight. I think to get a clearer view of what 2016 looks like, we have to take a much more interesting range. I mean, the high of the VIX future was about as high as the high we saw during the China flash crash in 2015, right? So, in many respects, 2016 from a 24-hour volatility view was more volatile than 2015, which people look at as an extremely volatile period of time. So, so for my point, I strongly disagree with our friend from Credit Suisse. I think we saw two complete outlier events in 2016 that maybe aren't hitting the stats the way that she analyzes them. And so maybe the way she analyzes them, maybe we end up a little higher. But I think I would be a seller of more than one big overnight events for 2017. I'd be at 1.5, let's just say. So in that respect, I think that maybe 2017 is going to be less exciting.
Only one Brexit or election in the thing, not two, huh?
I'm half bid at 1.5.
I mean, that's a good point, though, about the frame of reference for the data, because that was my initial thought as well when I first looked at that. I was like, 28? It just doesn't, I mean, I looked at the numbers, and it makes sense. I could see intraday, but you're right. It doesn't feel right, and that's because of the overnight hours, and that's, of course, become a bigger part of the session. I mean, I saw the numbers coming out of the CBOL last year, and they did record numbers in those extended hours for the VIX futures, and that's where a lot of these events are actually happening. Of course, Brexit happening in those hours, and then the election playing out, at least a lot of the drama of it initially playing out in those extended hours as well. So you're right, kind of excluding that from the data set is going to truncate it and maybe give you a little bit of a misleading thought. If you also have issue with that high of 28 listeners, and a lot of you seem to do, judging from your responses, we're going to get your pulse on that in a little bit. If you haven't voted in our question of the week yet, head on over to @options on Twitter and do so. It's been an interesting one to see your thoughts pouring in on that. Let's move on to VIX options for the week. It has been a pretty heavy week. Mark mentioned the settlement that always tends to drive a little bit of action, certainly compared to the last few weeks, one of the more active weeks we've seen out there. As of today, I said we're a little bit past noon here in the session Central Time, and VIX options have another fairly active day, still lower than the ADV, but about 470 going up, 476 right now. The ADV right around 560 these days. So it looks like will exceed it again today, and that's been pretty much the story for most of the week. About 830,000 contracts going up on Thursday, over 1 million on Wednesday, 1.05 to be precise, 700,000 on Tuesday, and about 414 on Monday. So one of the more active weeks we've seen in a while. And you might say to yourself, well, what strikes are lighting it up these days? Well, Feb's back on the board with a bullet this week. Number 1 and number 2 both coming on the Feb. Actually, a lot of Feb in the top 10 here. Starting off with our top 10 hot VIX strikes. Number 1, the Feb 21s with 247,000 contracts open there. Followed hot on their heels by the 22s. Maybe a little bit of a vertical going up there in Feb. I'll have to dig and see. The Feb 22s with 221,000 open there as well, followed by the Jan 23s, 211. The Jan, number 4, the Jan 21s, 182,000, so dropping down a little bit there. Number 5, the Jan 20s, about 175,000 contracts open there. Then the Feb 20s, a little strike parity here, 173,000 for number 6. Number 7, the Feb 30s. You can't go a week without the some 30 strike from some month being on this list. The Feb 30s, 173,000 contracts. Number 8, the Jan 17s with 164,000. Number 9, the Feb 17s, 163,000. And number 10, the Jan 22s with 163,000 contracts. Overall, like I said, a fairly active period. About 7.5 million contracts open right now out there in VIX land, which is fairly high. About 5.7 million on the calls and about 1.8 million on the puts. You know, Mike, I don't think I've ever had a chance to ask you this. I've asked this to all the other guests and people we've had on the show. But as I just mentioned, the Feb 30 strike is up there in our top 10 open interest strikes again for this week for VIX. It seems like every week, every month, the 30 strike, this continues to persist out there in the imagination of the trading public and of institutional traders. We've had a lot of people speculate as to why that is. I'm curious, what are your thoughts on that? Why do you think the 30 strike in particular has such magnetism to it? And does that factor into any of your analysis? Do you see this when you're out there, trading the VIX Futures term structure? Does 30 have this weird kind of place in your analysis as a result?
Right. So not in the analysis, our analysis specifically, but we talk to the floor guys and get flow color from them all the time. Actually, 75,000 block. Those Feb 21s went up again today. Bought. I think the 30 thing is just like the attraction of kind of a round number, and instead of buying, let's say, a couple $1 million of premium worth of 21s, you can cut the amount of premium you're going to lay out way down and buy a bunch more contracts, and you have your, China deval flash crash position on at a less expensive premium number. Almost like a catastrophic type of position. And I just think it's a round number thing.
Yeah, I agree with that to an extent, because obviously those round numbers have some cachet, but it seems to be almost regardless of any sort of context. It doesn't matter where the futures are. The cash could be 9. I don't care. People are trading the 30s. It's just a weird. It seems to just have a life of its own, regardless of what else is going on out there. And
that could be one player who has that in their model, that buying some of the 30s really satisfies a big portion of their VAR based model or something like that. And if you're using August of 2015 as kind of your scenario analysis, spot went from 1283 on August 14th, and August 24th it was when it printed over 40. So if you're burning some premium every month on the 30s and that is your scenario analysis, then it starts making a little more sense.
Well, there you go. A more reasoned reason as for why that is. But yeah, it's been an interesting one. I know I've commissioned Dr. VIX several times for some research as to that specific strike. But it does seem to have some sort of magnetism. You're right. Someone's model or multiple people's models out there seem to have 30 as the demarcation for beyond that lies catastrophe, or at least for them and their position, so they need to hedge there. Either way, it continues to draw interest. Speaking of drawing interest, Mark, I know you like to watch a lot of the various back and forth out there in the VIX options pit. Mr. Rhodes can't be here. He usually runs down to the floor and checks out what's going up this week. So anything catching your eye out there? I know we always talk, 1x2s. These days, both ways, in the puts and in the calls. Anything else out there? We talked risk reversals recently. Anything out there catching your eye, maybe from a trend perspective this week?
Yeah, Barclays and Morgan were out buying the Feb 22s in bulk. A few 100,000 of those have traded over the last couple of days. They've been paying at a clip. Big order that went up today a size up buyer of the February 14 size up seller of the February 14 puts unloaded something like 50,000 of the Feb 14s down to $1.29. So we've seen some pretty decent electronic stuff trade on the day-to-day so far. Outside of that, we've seen some activity at the Feb 1621 call 1x2. Actually, a big call 1 by 1.25 went up. So some things like that. Definitely seen a few large risk reversals where they buy like the 1825 call spread and sell an at the money put. Those have been pretty popular with vol down here. People basically saying, I'm willing to be long vol below 12 to get hedged and really long vol above 20. That's kind of been the way the paper has flowed from an institutional base, which makes some sense. So those have been the big trades. The Feb trade was today. Notably, they dumped a ton of those.
Feb puts and the 22s. I'll explain why they are so high on our top 10 list for this week. And interesting about the no more 1x2, 1 by 1.25. Maybe that's the new fancy ratio. And you got to play with that somehow. That 1x2 has been going up steadily for size for over a year now, year and a half probably. So you got to find some way to play with that and make it your own. Maybe that's the new ratio du jour. We'll keep an eye on that. Meanwhile, let's move on to some of the commodity space. Again, if you're hot on all things commodity volatility, stay tuned to TWIFO coming up earlier these days now, kicking off 2017, bringing TWIFO to you a little bit earlier, 1:30 instead of 3 p.m. Central. So if you're in the Mixler and you want to check back for that, 1:30, mark it on your calendars, where we do a deep dive into all things crude vol and about everything else going on in the world of futures options. But that said, it has been an interesting time to watch our crude vol through a variety of lenses, including two of our favorites here, OIV and OBX. Those are the various CBOE crude VIXs. OIV, of course, measuring your WTI VIX, you have WTI volatility, OVX measuring USO. Both of those back down south of the 30 handle again, was an interesting talking point for last year, how it seemed like there was an interesting floor around that 35 to 37 level, and both of them broke through it aggressively to the downside. It seems like a crude vol still kind of languishing in that trough there, which is perhaps potentially interesting for some of our listeners out there if they're thinking about putting on some long premium positions out there in crude land. Not going to cost you as much, perhaps, as it was. Pay attention to that skew. We talked for a long time out there how the puts had the premium. That has changed a little bit, particularly in the front portions of the term structure with the front month and second month or so. The calls exhibiting a nice, hefty little premium. Again, we'll get more into that in TWIFO. But I don't know. Mike, I know you guys mostly watch the VIX Futures and the broad equity futures. That said, you obviously have a lot of models and a lot of indicators out there on the way, on other products to keep in mind as you're doing your analysis for the mullet versus Tellum debate on a weekly basis. Anything catching your eye out there in the land of the big crude futures and the options on them, and particularly from a volatility perspective?
Yeah, I think, the cross-asset stuff is definitely part of our model. And what we look for is cross-asset correlation to equity vol or, VIX futures, how that flows through. And that really hasn't been high on the sensitivity list recently, just with crude, kind of in this new higher trading range. It was far more important, or much more the hot button beginning of last year. When crude crashed below 30, oil vol was through the roof. That was really having a lot of cross-asset vol spill over into equities. So it's all kind of quiet on the Western front in terms of that specific correlation for us.
That could be the name of another strategy, all quiet on the Western front. You might have to abbreviate it. It's a little bit long, but I could see that being another addition to the Typhon arsenal. By the way, someone asked me this recently. I don't think I've ever asked you, why Typhon? Was Typhoon taken? Is that what it was, or is that standing for something else?
I don't know. We'll have to ask Atulus. That was his name he came up with.
Isn't it some sort of Greek thing, right? I mean, that's.
I assume it's some sort of Greek thing, yeah.
I just assume you're going for Typhoon. That was taken, so just slash the O and you're good to go. But there you go. Now our listener who asked me that, they have their answer. Mark, I know you guys mostly watch crude vol through the lens of a USO, but of course you like your OIVs and your OVXs as well. Anything catching your eye this week, and does it really surprise you that crude is still kind of languishing here from a vol perspective?
No, I mean, it hasn't been doing very much. I feel like crude's going to back off a touch at some point. I think it's a little overdone, but really, I mean, I don't see a lot for crude to do. So no, I'm not surprised that vol's languishing. The one I continue to wait for bond vol to explode. I feel like if there is an area where there is market risk, it's in the bond sector. It's in, some pieces there. But nothing has popped up there even.
Yeah, it has been an interesting area, of course. That Fed study we talked about last week also shedding a lot of interesting light on the corporate bond market and the volatility therein. Interesting stuff. We were debating that on the Stack Dodd-Frank panel this week. Maybe we'll get to that in a little bit. But fortunately, it's time for you guys now to join us on the program. Make your questions and comments and complaints heard. It's time for the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, everybody. Welcome to the Volatility voicemail. Like the man said, this is the portion of the show where you guys get to take the reins with your questions, your comments, your insights. Hit us up by the website and all the other ways he just listed. Of course, if you're in the Mixler and you are so inclined, I think you have to have a Mixler account to send it. So if you haven't done that, set one up, and then you can ask us questions straight there as well. I know a lot of you guys like to stream and then hit us up via Twitter and stuff. That all works too. So hit us up, whatever your platform of choice may be. Meanwhile, we had asked a question at the beginning of this week, one of our questions of the week. This one getting a lot of interesting back and forth. This goes along the lines of what we were debating earlier here on the program, that high point of VIX. We said to you guys, hey, VIX hit a high of 28 last year. How high will VIX get in 2017? Pretty straightforward, a pretty basic question. We gave you guys 4 choices. We said about the same, 27 to 29, slightly lower, so in that 24 to 26 region, slightly higher, so in that 30 to 33 region, or much higher, which is above 33. Interesting. The votes coming in. It's very interesting stuff. Mike, you're our guest. We'll give you pride of place. I need 2 things from you. I need your own personal vote. Where do you think the high of VIX will fall for 2017? And then I need what you think is winning our poll.
So I'm going to say the high VIX for 17 to be 32 area. So whatever bracket that gets me in. And I think what's leading your poll is basically the about the same.
Interesting. So you're going to go in the slightly higher, which is 30 to 33 range, and you think about the same as winning. Interesting. Mark, same question for you. What's your vote, and what do you think is winning?
What are my options again?
Basically about the same, 27 to 29, slightly lower, 24 to 26, slightly higher, 30 to 33. That's where Mike is, or much higher, above 33.
I think that much higher is winning, and I'm going to agree with Mike that 30 to 33. Interesting.
Yes, you are correct that much higher is winning, 41%. It was close to 50% earlier in the week. It seems like some last minute votes coming in here for a more measured approach to volatility. Only 41% now as opposed to nearly 50, above 33. 25% number 2 for slightly higher. So in your camp there, Mike, 30 to 33, and then a tie for about the same and slightly lower. Excuse me. If you haven't voted yet, you got to think about a day or so left. This question of the week, it goes into the weekend. I forget if it expires on Saturday or for an early Sunday. So you got about a day or so. If you haven't, get over there at Options on Twitter. Make your voices heard. I know a lot of you already have. It's been interesting to see how all this shapes up, and I have a feeling, given that debate we had at the top of the show and given your responses to this will be a question that will rear its ugly and interesting head again sometime pretty soon here on the show. All right, let's see how many we can get to here on the old program. All right, this one comes from, I like this name, ChilliBill. He says, the Fed report from the last show was pretty damning. Any other secret studies on I think you meant to say Volcker and volatility lurking out there? Mike, I don't know if you're familiar with what he's referring to. On our last show, we debated this, and actually, like I said, this was a hot talking point on the panel I ran this week about the future of Dodd-Frank and what impact it's going to have on the markets. Obviously, the Volcker rule, very near and dear to the hearts of a lot of listeners of this program. It, of course, prevents banks from getting out there and making what they term to be speculative investments and getting rid of those prop arms of the banks. A lot of people on this program have debated and argued that that has caused less liquidity and, as a result, more systemic volatility in the marketplace. But there wasn't a lot of hard data on really either side until a couple of weeks ago when the Fed, right like a day or two before Christmas, sneaks out this very interesting study. It was called, I believe, it was pretty much the impact of stress on market making, and it was focused on corporate bonds. You could see in the outline there, Mike, exactly what the results were. But they effectively found that the group of bonds post-Volcker rule exhibited effectively more volatility, larger price impact, and less liquidity than the period just before the Volcker rule was implemented. They said they found the disturbing results that illiquidity in these stress periods is now approaching levels seen during the financial crisis. So again, Mike, you're our guest. You get pride of place here. Any thoughts? I mean, this probably is something that's occurred to you as well, but there hasn't really been any anecdotal data that I've seen or empirical data on VIX Futures proving this. What are your thoughts on this particular study? Do you think it applies to volatility in VIX and S&P as well? And then maybe do you have any other data points for our friend here? What was that name again? ChilliBill.
Yeah, good name, by the way. Now, I think it's probably, I haven't had a chance to read that study, but it makes sense to me that it would be, a little more specific to an over-the-counter market like bonds are. Who is going to hold that inventory to be able to make markets if banks aren't allowed to? I think, as it pertains to VIX and VIX Futures, that would rear its head in a month like December of 2014, when crude started really crashing and the energy high yield spreads blew out. We saw a ton of crossover buyers in VIX Futures out of the high yield management segment of the asset management business. And, equities weren't doing too much back then. They're actually on that, nice recovery rally from the Ebola scare in October. So there have been acute times where it affects VIX and VIX Futures, especially since high yield trades, so much like equities. But I think, Volcker rule going forward, if the thing is fully repealed and banks are just back in doing the same stuff they did before, yeah, it may make, equity market making a little smoother during the day. But I think ultimately it makes the market more volatile. In the intervening period, I think the market has perceived that the Fed and central banks as kind of the ultimate liquidity backstop or calming influence on the market, because they know they have no choice. So it's the banks aren't going to be there because they're not allowed to be there. So I think ultimately you probably get a more normal market. Having VIX be this low for this long is not something that's been normal sort of pre-heavy central bank intervention. So I think it'll go kind of full circle if Volcker rule is fully repealed and banks are back to being able to make markets in equities and everything else.
So you think it'll actually be more volatile if they repeal the Volcker rule than less?
I think ultimately it'll be more volatile by the way of just going back to a more natural rhythm. I think it's been the natural rhythm in the market. VIX has averaged 20 for a reason over time, and it hasn't even come close to averaging 20 post-Volcker rule. And I think a lot of that is, the perception of the Fed put out there. I think if you go back to a natural market ecosystem, volatility will rise on average to a higher level, a more natural level.
Interesting. I haven't heard a lot of people expounding on that there. I've heard a lot of people in the space saying they think, Volcker has exacerbated volatility. I've never heard anyone say, at least yet, that returning to what it used to be. Obviously things were volatile then too, so it wasn't like it was a quiet period pre-Volcker all that time. but I haven't heard anyone put it in quite those terms, which is kind of interesting. Mark, we talked about this a little bit last week. Anything else you want to add here, either on this study or maybe do you agree with Mike that if we go back to the old ways, we're going to see more volatility rather than less?
Well, I think it depends how that rule's unwound. I think not allowing banks to make markets is silliness, but at the same time, having just no regulation on their internal props and their internal prop shops is a completely different story. So I think one of the things the Volcker rule has taken away is the natural role of the bank or the upstairs desk of taking the other side of paper. However, some things that the Volcker rule maybe was intending to get rid of that they maybe did is the large bank prop order generation. So it's one thing for a big bank to generate an order to manage parts of their book. It's another thing for them to generate an order in order to try and put on a position. When they went to go fix that, I feel like they went too far and took away, on top of some things that maybe aren't a great fit for banks, all the things that are such a good thing for banks. Banks are in the service and in the business of assisting their customers. And when you take some of that ability away, it causes problems in liquidity. To Mike's point, if we full on repeal everything and say, hey, you guys go back to the Wild West, that could bring some volatility. I doubt that's going to happen, but I do think that there's going to be some hard changes that allow banks to get back into the business of actually making markets.
It's funny, particularly when you talk about the products we talk about on this show, which are so heavily institutional, VIX and SPX and some of these other more esoteric ones. When you strip away a lot of that institutional liquidity, does a lot of the guys who are backstopping these products. You don't get a lot of mom and pop retail working 1,000 lots in VIX options or whatever. So it's kind of an interesting and very, very much in the microscope, these products in particular. We got a question here from the chat room, FKS Them. That's an interesting handle. He wants to know more about those calls we were talking about earlier, Mark. He says, what's your take on these large buys in the Feb 20, 21s, and 22s out there in VIX this week? Well, we touched about on that a little bit at the top of the show. Those were kind of, like I said, those were leading the charge in our top 10s for this week as well. The Feb 21s with about 250,000 contracts, Feb 22s with about 221,000 out there. So those two were leading the charge. Mark, I believe you said it was Morgan and a few others that were out there gobbling up there. Apparently, that's the new hot strike. Was that also in your 1 and 1 1/4 vertical? Was it that 1621?
Yeah, it's all different pigs. So Barclays and Morgan are more in the business of just go out, buy a call. Some of the more nuanced, this new 1 by 1/4 is kind of flipped on its head in that you go long and then short 1 and 1 1/4. The idea being that you need a VIX of near 40 to create a problem for a 1 by 1.25, and it significantly lowers the cost because you're getting short skew. You then also trade it against futures. So that's that trade. So there's I forget what was my point.
He just asked about the call strip up there, the 20s, 21s, and 22s.
Everyone just heard me in the background and is cracking up. So
they find you to be very humorous, sir. But yeah, he was just asking about the 20s, 21s, and 22s. He talked about on that mostly earlier in the program. But yeah, it was interesting week. I think Feb's obviously on the board in a big way this week, and I think this is perhaps, who knows. It's not as aggressive as, or not as crazy, shall we say, as the 30s, but those strikes I think will be on our top 10 list for some time to come. We got to keep rolling though with the show. Time to go into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right. Well, listeners, last week, you'll remember, was a bit of a flipping of the script with Russell actually going lower on VIX and Mark trying to go higher. Usually for pretty much all of 2016, it was that way. I was right in the middle. And it looks like I took another one this week. I was at 11.5. We closed 11, or not closed. We're printing right now at the end of the show, 11.27. It was a close one. Russell and I were almost equidistant, but I eked him out by Looks like two hundredths of a percentage point there or so. We'll see how that plays out. Mark going high road this week. Didn't get you. You were 12.01. Didn't do it for you. That means I get to choose. Well, actually, no. We have a guest, so I'll be the duteous host and allow our guest to go first instead. Mike, of course, you know the drill. This is the portion of the show where we prognosticate wildly and recklessly on what the volatility gods hold in store for this time, the end of the show next week, so right around 1 p.m. Central. Where do you think VIX Cash is going to be lining up next week, sir?
Next week, I'm going with 1451. VIX Cash, I think you have a couple things. You have expiration in VIX next week and monthly SPX and other option expiration. And your next 30-day window includes, kind of the bulk of earnings season, the inauguration, and also with spot at in the low 11s, the siren song of a preteen VIX will be too tempting for people not to buy some protection, because with February future trading 1420, a lot has to go right and very little has to go wrong for that to move higher.
Wow, 1451 you said, right?
That's what I say. Yeah.
So you taking Russell's place on the upside buyer here in volatility. There could be something to that. Of course, this time next week when we're doing the show will be inauguration day. So whenever Trump speaks, things seem to happen. So they could intra show even we could see a huge spike in volatility as a result. So I think that could potentially be the way that we're feeling. I'll go next. I'm not quite as bullish on vol for next week, even though I could see where you're leaning there. You are as a creature of the futures at the end of the day, and that's kind of what the futures are saying. So I see what you're saying. I'm feeling a little bit more vol, but less than you're feeling. I'm going to say I'm flirting between 12.5 and 12.25. I'm going to go 12.25 for next week. A little bit more, but not perhaps quite as volatile as you're feeling. Mark, take us home, sir. What are you feeling for next week, inauguration day here for volatility?
All right. I'm going to go the low. So here's my only worry. I think that we're going to see a settle of VIX of below 11. All right. That'll be one of my bold predictions. And then I'm just going to stay right here. I'm going to say 11 and a half.
11.5 for next week. There you go. Might get you in the victory books here for 2017. Kick it off. All right. That's going to do it here for the crystal ball. That's also going to do it for this episode of Volatility Views. There it is. Waiting for that music to kick in. Can't close the show without the tune. All right. But before we go, one last time, let me check back in with my cohorts here. My partners in crime, see what they're working on. Mike, we'll start with you, sir, one last time. What's cooking in the land of Typhon? Any some cool strategies coming up? Any well-named strategies? And also, if people like what they heard from you this week, they want to check out what you guys are up to. Where should they go? What should they do?
Sure. Always working on cool strategies and, definitely the code names behind those. TyphonCap.com is Typhon's website. It's TYPHONCAP.
There you go, TyphonCap.com. Check them out for the friends over there. KS in the chat room, thanking us for our extra color. You're welcome, sir. All right, Mark, last but not least, sir, what's cooking in the land of Carmen Line and indeed Option Pit?
We got our big volatility masterclass starting Tuesday. You can sign up at optionpit.com/events.
Sorry about that. There we go. All right, optionpit.com/events to learn more. The masterclass. So if you too want to get your masters in volatility, you can get a nice little paper from Option Pit that says you too are volatile. Maybe get a cool cap too. I don't know. I'll have to check out the tchotchkes you get with the class. You can check it out yourself, optionpit.com/events. And our friend, of course, Mr. Rhodes, going to be here from SIBO. Head on over to CBOE or just search for livevol.com. They have that nice little green button. That's you're asking us all the time, which analytics do we use for this show? What we use platforms? We use LiveVol, not just because they're sponsors. We were using them a long time before that. That's how they came onto the show, quite frankly, because we use them all the time. Check them out, livevol.com. Click on that green button and get a free trial. Kick it out for yourself. And of course, if you want that bespoke data, search for the data shop there, and you can get whatever data range, whatever product you want. And on behalf of Mr. Russell, who couldn't make it, and Mark, and of course, Mike and the whole team at Typhon, and indeed myself, I thank all of you for joining us on Volatility Views, and we'll see you next week for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.